Hello, welcome back, everyone. It's David with Ag Economic Insights joining you for the chart of the week. I want to share a follow-up from a video we did a couple weeks ago looking at the historic returns of alternative lease arrangements for farmland using Indiana data. And that was from the landowner's perspective. This is looking at the tenant's perspective. So, got two links down in the description below to if you want to read up and follow the articles and the details more specifically. But the thing I want to point out here is the first thing to mention is that what we measured here is returns to overhead after the rent's paid. So we took revenue minus variable costs of production minus the rent of these alternative lease agreements. We looked at it since 2010. And as you can see, there's quite a bit of difference here as you look across these data. The first thing I want to point out is you can go several years with one lease looking really attractive to the farmer. And so you can see here that this green line is a crop share. So uh, this can look pretty alternative than this lean year, another year over here where it's alternative. But then all of a sudden, this return to the farmer. So they're getting less returns to overhead. They're paying a higher cash rent in these boom years that we see in 2010 to 2012 and 13, and again 2022, 21 to some degree. And so there are long periods. And so keep that in mind as you're thinking about lease agreements. There can be stretches where option one alternative is much stronger, and then that could flip a little bit. The other thing to keep in mind is that some of these uh, perform better in I guess some of these performances better align with conditions in the farm economy, right? So if you think about this cash lease here, it's giving you the lowest returns to overhead in really lean years. And so this means that the lows are even lower, the highs are even higher. And so cash rent is a real big multiplier of what happens in the farm economy. So the boom years feel even bigger with cash rents, the lean years feel even leaner. And of course, we see that in this particular example as well. Crop share, of course, it has a little bit of a risk management flavor to it. It helps smooth that out a little bit, a little less volatility or variability over time. We think about those returns to producers. The booms aren't as big and the lows aren't as low. So there's a little bit of a trade-off there. So of course, this is one of the charts for this article. There's a couple more to dig into those annual returns to the alternative lease agreements. We also looked at that volatility in more detail. Check out the links below. Till next time, stay curious.